Hello everyone. So in today's video we're going to understand what are real estate investment trusts or REITs, and then we'll also talk about what are infrastructure investment trusts or InvITs. So if you talk about REITs, we all would, if given a chance, love to own commercial real estate properties such as shopping malls or office complexes, but we know that it's almost impossible because buying them is going to cost a lot of money. But you have financial instruments such as real estate investment trusts which allow individual investors to invest in these real estate properties but without actually physically owning them. So these are financial instruments which provide investors an opportunity to invest in real estate without physically owning them. So the way these REITs work is that they work similar to how mutual funds work. That is, these REITs pool in money from different investors, and once they have a corpus of money, they use that money to purchase different real estate assets such as warehouses, office complexes, shopping malls, so different types of commercial real estate properties which are lent out and a rental income is generated. And this rental income which is generated is distributed amongst the holders of units of REIT. So this is what REITs are. So if you talk about the way holders of REITs generate return, the first source of wealth generation is rental income from different properties which REITs hold, such as malls, office spaces, and so on. The second source of income for holders of REIT is capital gains, which arises if the price of unit of REIT rises. So let's say the real estate investment trust which you have invested in holds multiple properties, and across different properties the average occupancy of the different real estate properties is around 70%. Now let's say because of sudden economic demand the occupancy has risen to around 90%. Now for any investor who's interested in buying real estate investment trust units, he'll clearly see that if the occupancy rises, then the total rental income which the real estate investment trust is going to generate is going to rise, and as a consequence of that he'll be more interested in buying units of that REIT, and as a result of that the price of REIT units is going to rise. So consequently you can have capital gains which arises by holding REIT units if the demand for REIT unit rises for whatever reason. So these are the two ways in which holders of real estate investment trusts earn money. That is, they generate a rental income because the different properties are leased out, and the second way is that there can be capital gain in the price of each unit of REIT which an investor might be holding. However, thing to remember is that REITs are units which are purchased and units which are listed on different stock exchanges such as the National Stock Exchange or the Bombay Stock Exchange. They are not direct purchase of real estate property. So when you buying a REIT unit, you are essentially buying a unit which is listed on the stock exchange, and we know that stock markets are subject to different types of fluctuations for different economic reasons. So there is a good possibility that even if the real estate market is doing well, say that different commercial properties are generating adequate rental income or there is a robust demand for rental properties, but there is still a possibility that despite that, if the stock market is not doing well, then the unit price of your real estate unit might decline. So that is a thing about real estate investment trust units, because these are, even though they provide you exposure to real estate, you are end of the day buying a financial instrument which is listed on the stock market. So this is what real estate investment trusts are. Now the second type of financial instruments we want to talk about are InvITs. So these are financial instruments which allow investors to invest in different infrastructure assets. While in REITs you are investing in different types of commercial real estate properties, large scale real estate properties, Invest IITs allows you to generate income by investing in those infrastructure assets which generate a high income, such as you could have toll based highways, you could have power transmission lines, and so on. And traditionally what was happening was that investments in these infrastructure assets was typically confined to large institutional investors, because one had to invest a massive sum of money. But invest IITs like REITs provide even small scale investors an opportunity to invest small sums of money and thereby get exposure to a portfolio of infrastructure assets which the fund might be holding. So similar to REITs, infrastructure IITs also generate returns via two broad means. So the first is that the holders of units of invest IITs receive periodic cash payments which arises from the operation of different infrastructure assets. So let's say a invest IIT owns a particular toll highway. So the invest IIT is going to get payments for tolls because of the different vehicles which operate on that highway. Now most of the income which is generated from these tolls is going to periodically get distributed amongst the holders of invest IT units depending on the number of units they are holding. The second is that, like in case of REITs, the holders of investment infrastructure trust units can also experience a capital gain over time. Now this can arise if the value of assets which the infrastructure investment trust holds appreciates for whatever reason. So let's say there is this toll highway, let's take this example further, and this has X number of vehicles which operate on that highway. Now let's say because of increased economic activity in the region, the number of vehicles which are operating are increasing exponentially. So any investor who wants to invest in infrastructure assets can clearly anticipate that in the future the tolls which the highway is going to generate or the highway operator is going to generate is going to rise, and thereby it is beneficial to invest in any infrastructure asset which owns that highway, because he's going to get a much higher cash distribution, and as a consequence of this the demand for units of this infrastructure trust is going to increase, and thereby the price of these infrastructure investment trust units is going to increase, and thereby you can have a capital gain as a consequence of this. Now if you talk about what are the overall benefits which the holders of infrastructure investment trust units or real estate investment trust units receive, is that firstly, because these financial instruments are regulated by SEBI, so any investors in these units can be assured that there's going to be transparency and investor protection. That is, the funds which they have invested and the funds which are being invested in different types of real estate properties or different types of infrastructure assets, an investor can be assured that he's going to get a return which he actually deserves. That is, these infrastructure investment trust units or real estate investment trust units are required to make disclosure on aspects such as what is the occupancy rates of different types of properties. So all these mechanisms ensure that there is transparency and investors know that the funds they are generating and the returns they are receiving is in sync. The second benefit is that these financial instruments provide diversification to investors. That is, they enable investors to get exposed to real estate assets in addition to traditional assets such as stocks and bonds. The third is that these financial instruments allow different developers and infrastructure companies which are creating different financial assets to sell the assets they have created and thereby generate fresh capital for new projects. So let's say there is a developer who's built an office park and he spent 5,000 crore rupees. Now if he wants to get back the money he's invested through rental income, that is going to take a significant amount of time. So he could sell that property to a real estate investment trust and get the fund which he can use for further projects in the future. In regards to an investor, the benefit these financial instruments provide is that they provide greater liquidity, because these securities are listed on the stock market and they can be easily bought and sold, unlike the case where you are directly owning a real estate where it may take some more time to sell a property if you own that. The other benefit they provide to investors is that because an investor, if he is investing in real estate or infrastructure assets, receives a regular cash payment, so they provide a stable income stream. And the final benefit these instruments provide is that if you invest directly in a real estate property, then you have to deal with the process of investing and the hassle which comes with it. That is, you need to be involved in things such as you need to register the property, you need to find a particular tenant so as to lease your property so that you can generate income from that property. Then you need to manage the tenant you've leased your property to. That is, you need to ensure that rents are paid on time. You need to manage the property on a day-to-day basis pretty much, so as to ensure that any repairs, if they are there, are looked into. So these are the different aspects which someone who directly purchases a property has to deal with. But if you buying these financial instruments, you are getting pretty much the benefits of real estate assets without having to go through these hassles. So this is what we want to study in the context of REITs and InvITs. I hope you like this video. If you did, follow the channel for more concepts in regards to UPSC economics. Thank you so much for watching.